This is the Investor Connect podcast program. I'm Hall T. Martin. I'm the host of this show in which we interview angel investors, venture capital, family offices, private equity, and many other investors for early stage and growth companies. I hope you enjoy this episode. Hello, this is Hall Martin with Investor Connect. Today we're here with Chenoa Farnsworth of Hawaii Angels. Chenoa, thank you for joining us.
Thanks for having me.
So what was your background before investing in early stage companies? What did you do before this?
Yeah, I had a management consulting company and I worked with a lot of early stage companies as clients. Had that company for about 10 years and had clients in a broad range, but of sizes and stages. But the stuff that really excited me was when I got to work with early stage companies.
Great. So tell us more about the Hawaii Angels and that angel network. How does it work and what's it all about?
So Hawaii Angels is actually one of the older of the angel networks in the country. We were established in 2002, which, believe it or not, it makes us one of the senior members of the ACA, the Angel Capital Association. We were one of the founding members of that group in 2004. So we've been around for that long, which is a long time in the angel world. We are a nonprofit, so we're structured as a business club, if you will. We have members that pay dues, and each member makes investments on their own. We had a fund structure for a time, but currently we do not. And so each individual member makes their own decisions. And our job as the organization of Hawaii Angels is really just to facilitate the process of screening the companies, getting the companies in front of the investors, which we do in a monthly luncheon format, and then organizing kind of the due diligence and follow-up.
That's great. So let's talk about the state of angel investing in general. How do you see the industry evolving for angel groups? What changes do you see coming up?
Well, I think angel investing in general is a kind of geographic specific type of investing. Most angel groups that I know are very focused on their own geographies, and that's kind of the nature of it, which makes it a little bit different from venture capital, which may flow a little further into different geographies. So we are very geographically focused, although we do deals outside of Hawaii. The vast majority of the deals we do are in Hawaii, and I think that's pretty typical for angels. They like to invest in their backyard, so to speak. A lot of angels invest for reasons other than just pure financial returns. They invest because they want to be involved in their community. They want to give back. They want to share their advice. Most of them have rich experience running their own businesses and operational experience and networks that they can bring to bear for these early stage companies. So in a lot of ways, it's a mechanism for giving back, and it's also a mechanism for staying engaged and involved and educated. Our members love to learn new things about new industries, and I think that's also pretty typical of most angel groups out there. A lot of folks do it to stay kind of up on the latest. Maybe it's technology trends or other new business ideas, sustainability, things like that. So there's a lot of different motivations. So I think we're kind of typical in that way of the angel industry.
So what's the biggest challenge you face today with your angel group?
Well, we are faced with a kind of generational shift, I think. And again, I would say that's not atypical of angel groups around the country. Most got started around the same time we did. And a lot of our members, our original members from now nearly 20 years ago, are aging out of being able to make investments. So recruiting newer members and younger members is a challenge for us. And I think, again, that's pretty typical. Diversity is a challenge for us as well. We don't have, despite the fact that I'm running the group, we don't have very many women in the group. And that's always a sticking point for me personally. I'm always trying to get more women involved in angel investing. So, and if I do attend an Angel Capital Association meeting, I get the same sense there. It's a lot of older folks and white, primarily men. So I think the industry as a whole has a kind of diversity and generational problem. And we have the same issues here at our local club.
I see. Well, let's talk about the investment thesis for your group. What exactly is it? And can you talk about a couple of companies you funded that fit the thesis?
Yeah, so I guess in general, we're investing in what would be categorized as high risk, high reward types of companies, right? We do occasionally look at deals that are more in the kind of low risk category, let's say small businesses or real estate development, that sort of thing. But the vast majority of what we do is in that high risk, high reward category, which kind of lends itself to mostly technology companies. The reason we do that, of course, is, as we know in investment theory, for this type of investing, it is so risky that when we do get a company that makes it big, they need to be able to make it very big to make up for our previous losses, which are inevitable in this type of investing. So that's our tendency. We tend to invest in those kind of swing for the fences plays because that's kind of what makes sense to us. And they tend to be, I guess, more on the technology side. So some, I guess, recent investments that have done well, we've invested in quite a few kind of double bottom line companies recently. That's another trend that I'm seeing. Our members are really interested in doing well by doing good and that sort of thing. So we invested in a electric car charging network called Volta Charging. That company is doing quite well. So we were kind of their first money in, and they've just raised their last round valuation was, I think, 200 million. So they're doing quite well. And we also have invested in another company that does water filtration systems that are not with disposable bottles. So kind of bring your own bottles, water replacement. So that's called Flow Water. They're also doing quite well. So those are some examples of kind of the newest trends, I think, which are more along the lines of double bottom line.
Great. Sounds like you have some good portfolios there. So in general, what excites you right now in the angel world?
I guess much of the same. I'm also very interested in those companies that are addressing a maybe environmental or social issue, and at the same time looking at a pretty strong profit model. Personally, not one that thinks we've got to sacrifice one for the other. In fact, in our portfolio, our impact kind of investments are outperforming our other investments. So I think there's a good economic reason for making those investments as well. So I'm really personally interested in those deals that kind of blur those lines. My most recent investment was in a company called Pocket Change, and they're kind of a platform for enabling charitable giving, but they do have a strong profit model as well. So I think things like that are exciting right now.
Well, great. So you meet a lot of startups, you meet a lot of investors, and have seen fundraising go on for some time. What's your advice for those who are starting to invest in startups today? What do you tell them to do before they write that first check?
Well, whenever I sit down with a new member or a potential new member, I do like to go over some of the basics, which are that you need to build a diversified portfolio, just like you do in public investing, right? So that if you don't have enough capital to make at least 10 investments in these types of deals, then you shouldn't start at all because you're likely to lose your money. It is very hard to pick winners. So if you're kind of going into it thinking that you're smarter than the next guy, I can promise you that you're not. and that smarts honestly don't have a whole lot to do with it. They can help you avoid mistakes, but in terms of success is a derivative of so many factors, some of which we can control, many of which we don't. Markets change, demand changes, competitors change, all of these things that are external that we really can't control for. So there's no such thing, in my opinion, as a genius investor. So you really just have to build that diversified portfolio. So that's probably the main advice I go into with it. Make sure you've got at least $500,000 in the bank that you are interested in putting into this type of investing.
And so on the other side of that table, what's your advice for those running startups? What do you tell them to do before they launch that business?
Well, I'd often tell them to try to get as far down kind of the field as they can without getting external funding. So probably the most common thing that we see are companies that are asking for funding too early. And the problem with that, of course, is you might be successful in raising money, but you're going to give away a big chunk of your company, which in the long run will pose problems for you and becomes demotivating, right? If you don't have enough skin in the game after your third or fourth round of funding, things start to fall apart. So really trying to get as far as you can with as little as you can. So bootstrapping, friends and family money, really delaying that first check from somebody, as I like to say, that does not have a reason to love you is really the best advice, because once you start to go down that road, many other things come into play. You've got a lot of cooks in the kitchen at that point. You've got a lot of people to answer to. It's no longer just your show. So you need to be cautious. And if you're in a good, strong position going into that negotiation, you've got good traction, you've got a good business established already, then you're able to drive, obviously, a good price for your company, which is important for retaining your equity and ownership, and also to negotiate terms that are more favorable and the like. So just trying to get as far down that path as you can without taking in external money.
Well, in general, how do valuations compare to, say, the Bay Area or New York or the Midwest? Where would you say valuations in Hawaii come in relative to those regions?
Yeah, I mean, Hawaii is very similar to any other, what I would say, off market. So outside of those main hubs of investment. So we do have better valuations. We have lower valuations here versus the Bay Area. You're probably talking about a 25% discount from, a similar company in the Bay Area. So, that's also makes it difficult for us to invest in those companies, right? We see deals from the Bay and we're like, what? This company is not worth $10 million. Our perception is very different, right, than theirs. So that's always interesting. On the other hand, we do have some investors who go back and forth a lot, and they bring deals to us or they invest in deals here because you can find a little bit more, I guess, bang for your buck here.
Well, it's good to hear. We're based in Texas, and in the Midwest, we find it's the same thing. It's quite a bit lower than the West Coast or East Coast. And in times of market crashes and so forth, that's to the better because valuations come down in market crashes. But if you're not too high up there to begin with, there's not that much room to go down in the second place. So it's really not that much of an impact. Whereas on the West Coast, East Coast, it's a tremendous impact. Many people can't survive it because the follow-on rounds are so far down below the previous rounds that it just can't be covered. But
right.
So it's a safer place to live for sure.
Yeah.
Well, in the last few minutes that we have here, what else should we cover that we haven't?
Well, I guess the situation currently with COVID-19 and how that's going to impact everything. I keep getting asked those questions. What's going to happen? Are investors still investing, et cetera, et cetera? I think currently we are not meeting. And I'd say on the plus side, we're probably next month going to have our first virtual meeting, which is something that we've been wanting to try anyway. So this kind of, has prompted us to do it. And hopefully that will be successful. Again, a lot of our members are not necessarily savvy with those things. So it's going to be challenging, but we're going to give it a try. So I think that's one immediate impact. But even if we are successful at doing the online pitches and all of that, and say it goes as well as it could, I'm still not sure if there's much appetite. Our members have lost a lot of wealth on paper, at least in the last month. Everybody's a little spooked by that. And I have investors on kind of both sides of the spectrum. Some say, well, I think there's bargains out there and I'm going to go find them. And others that say, I'm sitting it out for a while because this is too turbulent really for me to understand what's going to happen here in the next 6 months, next year, next 18 months. So on the flip side, my advice to entrepreneurs right now is if it's at all possible to, again, wait and not fundraise. Because again, I think you will end up giving away a good chunk of the company right now if you're even lucky enough to raise. So I think for entrepreneurs right now, it's really about cutting costs, not raising funds.
Right. I agree. I think as the market gyrates by 1,000+ points a day, it's going to have to settle down a little bit before investors know where they stand, and then they'll get back into it at some point. But it's too much of a gyration factor now. It's like a train wreck. You can't take your eyes off of it. You just got to stare at it.
Yeah.
So, but eventually we'll get past that, and eventually we'll come out the other side. And I think we'll see a lot of new technologies come to the fore, or existing technologies that are being adopted more widely: telehealth, teledistance learning, robotics, AI. There's a great need for having a lot of infrastructure in play. And, robotics and AI was, they were coming to take our jobs about a year ago, but now we're looking at some of those things as well. They can work through a pandemic without people. So there's something there to be had. So I think it's going to drive a lot of new startup innovation on the other side, but we have to get through it first.
Yeah, in fact, one thing we've been talking about is having our next meeting be completely dedicated to COVID-19 opportunities, which there are some. And we've got companies in remote work, distance learning, online productivity, delivery, even supply chain management, that sort of thing. So I think all of these telehealth, so these companies are going to be the winners or potential winners in the situation, and we should be looking at those.
Absolutely. And we do as well. Some are really finding a new growth story in the COVID-19 economy. And people talk about going back to the old way, but I'm wondering how much we'll go back to commuting to work, and how much we'll go back to education in person, and how much it'll just carry forward at some level. So the new normal will be interesting to see where it lands.
Yeah, I think absolutely things like telehealth will finally kind of get some traction. We've been talking about it forever, but now that we can see it working, I think, going back from that will not make sense, right?
Absolutely. Well, great talking with you today. How best for listeners to get back in touch with you?
Yeah, email, website, all of that. We're at hawaiiangels.org. Believe it or not, that contact sheet goes straight to me, and I answer every email. So it's pretty, we're a small organization. We're easy to get in touch with.
Great. We'll include those in the show notes. I want to thank you for joining us today, and hope to have you back for a follow-up soon.
All right. Thank you.
Investor Connect helps investors interested in startup funding. In this podcast series, experienced investors share their experience and advice. You can learn more at investorconnect.org. Halti Martin is the director of Investor Connect, which is a 501c3 nonprofit dedicated to the education of investors for early stage funding. All opinions expressed by Hall and podcast guests are solely their own opinions and do not reflect the opinions of Investor Connect. This podcast is for informational purposes only and should not be relied upon for the basis of investment decisions.